Andrew here from the Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 48. And today we're going to talk a little bit about the property market here in Australia, because I've been getting lots and lots of questions about what I think is going to happen to the property market. And over the last probably almost 12 months, and certainly the last 6 after we've seen a rapid increase in interest rates, I've been giving a fairly consistent response to the questions I get about the Aussie market. And I figured today we've got some hard data that supports a lot of what I've been saying for the last 12 months. So that's not to brag, but it is always helpful when you can support your theory with some data. And today this article produces that data. And as per normal, when we come to Woody's Weekly Wisdom episode, this one doesn't let us down when it comes to the headline and then the very final sentence or a couple of sentences of the article. So there's a little bit of fun to be had here as well. So let's look at the headline. New home loan commitments slip in January as rate hikes squeezes borrowing power. So it's a mouthful, but ultimately they've gone, I think, with a less emotive adjective in this headline than they probably could have. They've only gone with slip. I wouldn't have been surprised if they said fell off a cliff or any of those other more emotive ones, but they've been pretty generous here by saying it is just a slip in January. So what are they talking about? What have I been talking about? Well, let's delve into the data. So I'm just going to show the graph as I talk through this, because the article is not overly long. But as you can see, since the last month or so, there's been this quite dramatic drop in the number of new loans taken out or new applications for funding. So we saw an enormous amount through COVID, all this going on, lots of refinancing, and that was the boom that we weren't supposed to have because of COVID, the dreaded word. But let's look more at the current numbers. And so it basically says here that the number of new loans purchased by owner-occupiers was the most significant contributor, falling 4.6%, while mortgages taken out by investors fell more modestly by 2.6%. That kind of makes sense. Investors are being pretty cautious at the moment, but still investing, and the owner-occupier rate has definitely dropped. And so the overall drop was 3.9%. In the scheme of things, people look at that and go, well, that's not overly dramatic. But when you see it on the chart, you can see that it is relatively sharp, similar to this one here. And if this keeps happening month after month, then that's going to get a few people nervous. And so to tie it back to what I've been saying for some time now, these interest rate increases have taken a lot longer to impact the property market in general. Certainly it's hurt everybody's cost of living and their money plans in terms of the amount of money that is available for just general life. But when it came to the property market, these things have just taken a little bit longer to file through. And now we're starting to see some of that data to really impact what's going on. So a little bit of a false dawn in terms of this recovery after the drop-off here as interest rates were going up, and now we're seeing it again. So I think it's relatively safe to say that the interest rate rises and now the number of people who are coming off those very low fixed rates, now that's filtering through to the market. And we always knew or were told that it was Q4 and Q1, so Q4 2023 and Q1 2024, when the majority of those loans were starting to come off the low rates. And so that is starting to have an impact on what we're seeing here, as you can see with these numbers. We're starting to see those people coming off fixed rates, obviously having a massive impact on their capacity. And for a lot of people, it will be putting them into what is phrased, I guess, in the industry as mortgage prison, because rates have now risen to a point where they can't even pick the phone up and try and refinance because they've now found themselves at a level beyond their borrowing capacity, and so the banks are not going to let them refinance at this point because there's no capacity, even though that you might be looking to try and get a lower rate. It is potentially triggering the scenario where they've lent you more money than you could currently borrow. So that is part of the equation. But ultimately, what we're seeing is the fact that there's a little less ability or capacity for people to be borrowing money. And as a result, we've seen a reasonably significant, definitely from a data perspective, a 3.9 drop in the number of new home loan commitments is worth writing a story about. Is worth talking about. So that's the headline. And then they go on to talk about, what's driving this, or where is there a pocket of the market that we're looking at, we should be looking or talking about more than any others. But basically, the Reserve Bank hiking rates has put a squeeze on people, and that's pretty much the crux of the issue. And this sentence here, residential refinanced mortgages also continued to slide, falling 7.6%. So people are no longer looking for refinance, again, because of that mortgage prison potentially, or they've already done it. And that is a 7.6% drop is significant. When I'm talking to the people in my network, particularly in the mortgage game, they are letting me know that the phones have stopped ringing. And that they're not even getting calls anymore about refinancing or any new loans. So you get the on-the-ground data long before you get the real data, and that on-the-ground information is suggesting that I expect we'll see more of these declines in coming months, and just see that what I've been talking about for the last 12 months is a softening in the property market. It's starting to come out in the data. And so volume of loans higher than new loans for the first half of 2022, fallen sharply as lenders reduce competitive cashback offers. So there's just a general softening in the market, and we're seeing that, and that obviously will flow on to the prices in the market. Now, I mentioned that the article doesn't let us down when it comes to a conflict between the title and the content of the article. And sure enough, this one doesn't let us down at all, because we get the comments here that all the way up until this point, it's all been about the softening of the data, and then we get the slide in new home loan commitments comes as separate data released earlier this week suggests Australians remain aspirational and are feeling increasingly confident of owning their own home. So that would be in stark contrast to what the data's just told you, which is less people are looking to borrow. But we're feeling aspirational still, allegedly. And then we get the latest Westpac home ownership report found 44% of Australians plan to buy a new home in the next 5 years, up 9 percentage points since July 2023. So the next 5 years is a pretty long window. And sure, that's up 9 percentage points, and there is a little bit more confidence. And that, I would believe, is coming from the belief that in the next 5 years, rates will have fallen. So, there has been a lot of talk since the last interest rate rise about when will we have peaked, and when will rates start to come off. And so the more recent Reserve Bank of Australia notes or minutes suggested that the second half of this year is where they believe rates might start to fall. So that obviously breeds a little bit of confidence to borrowers, and to the general market. So if you were to ask them whether they were more or less confident of buying a new home in the next 5 years, on the premise that they're now understanding rates will be falling in that time frame, then of course more people are going to say yes than no. and certainly more than what would have said it in July 2023, when we're in the middle of a rapidly rising interest rate environment. So that one, is not at all surprising and not really that significant a piece of data. And then the last sentence really is the interesting one, or the fun one from my perspective. More Australians are also planning to buy an investment property, upsize their home, or renovate an existing dwelling, the research found. Again, over the next 5 years, but completely contrary to what the data has just shown us, which is, there's less people applying for money. And so buying investment properties or upsizing their home, renovating takes cash. It's going to require an application in most cases for funding. And the data says that's slipped. But let's finish the article by saying, but this other report says that it's people are more confident. And so that's just me and my sick sense of humour, showing that the article is a little bit contradictory of itself, without being overly contradictory, but still there's an element of contradiction in there, and that's not unusual because we do this every week and we see it every week. But I wanted to point out, and let's go back to the graph and just see that there has been a slip in the market, in the value of loans. And this is a very early indicator that the market is going to slow down. If less people are borrowing money, less people are buying, and therefore there's less pressure or less upward pressure on property prices. So with that information, if you are a property investor, that is good news, because it means there will be less people to compete with, and therefore a good possibility of you getting a better deal for your investment property. So always try and bring it back to our specific examples. And as I said, if you're a property investor, this is pretty good news. Maybe not in terms of the capital growth of that property, but at least you're not going to be overpaying in the short term because you're competing with a lot more people. So that's pretty good news. So that is this week's Weekly Wisdom, episode number 48. We're getting very close to number 50. And looking forward to bringing these to you more and more each week, because there's just so much good stuff to talk about. So if you are watching this on YouTube, make sure you hit the subscribe button up there and the little bell next to it to get notified. And then if you're watching on Facebook or LinkedIn, make sure you hit the like button, the comment button. Just let us know you're enjoying these things, and hit the share button. Share this around. More people will hear about it, the better. And we can spread the good news about financial literacy and supporting your wealth creation journey. And if you want to have a chat, feel free. You know how to reach out to us. Let's have a chat, see if we can help you. We'd love to be part of your journey as well. Have a great week. That is episode number 48. See you again next week. Cheers.